Good day, everyone. Today, we'll be looking at Module 12, Transfer Pricing and Tax Planning. We'll also be looking at it from the perspective of the role of transfer pricing in tax planning and administration in Nigeria. Let's begin by explaining what tax planning is all about. So, tax planning refers to the strategic organization of a taxpayer's financial and business affairs to minimize tax liabilities by making use of all available legal provisions, exemptions, and incentives. It ensures that businesses reduce their tax burden while staying compliant with the tax laws. So, strategic planning or strategic tax planning involves structuring a company's operations to achieve efficiency while complying with legal and regulatory requirements. Transfer pricing plays a crucial role in this process by determining how profits and expenses are allocated among related parties in different jurisdictions. Before we look at the key components, let me just say this. In Nigeria, courts have consistently upheld that planning is, or let me put it this way. In Nigeria, courts have consistently upheld that tax planning is a lawful activity. And one of such cases that actually prove that tax planning is a lawful activity is the case of GM Akinshete Syndicate versus Senior Inspector of Taxes, where the Supreme Court of Nigeria affirmed that taxpayers are entitled to use legitimate means to avoid paying excessive taxes. So this principle was also supported by Lord Tomlin in Duke of Westminster versus CIR, where he stated that every man is entitled, if he can, to order his affairs so that the tax attaching under the appropriate act is less than it otherwise would be. So that is the quote there. Now, an essential part of permissive tax planning in transfer pricing, which involves pricing intercompany transactions within multinational enterprise to ensure tax efficiency. So now let's look at the key components. Profit allocation. Now, with respect to profit allocation, ensure that profits are allocated, properly allocating profit to jurisdiction where value is created to optimize tax liabilities. Secondly, intercompany transactions. Structuring intercompany transactions such as sales, services, royalties to achieve tax efficiency is also very important. Now, before we move on, with respect to intercompany transaction, ensuring that those transactions are at arm's length is also very important. Now, let us move on, or let me just quickly explain the role of transfer pricing in both tax planning and tax administration in Nigeria. In Nigeria, for example, taxation at the federal level is administered by the Federal Inland Revenue Service, which ensures that companies and individuals pay their rightful taxes. Now, with the complexity of cross-border transactions and globalization, transfer pricing has become a crucial tool in both tax planning and administration. Now, just to give us more explanation, transfer pricing refers to the pricing of goods, services, and intellectual property transferred between related entities within a multinational group. So it plays a significant role by determining how profits and expenses are allocated across different jurisdictions. And that is the first key component here: properly allocating profit to jurisdiction where value is created to optimize tax liabilities. Now, for tax planning, transfer pricing helps companies to structure their intercompany transactions in a way that minimizes tax liabilities. You can see that's the second component that is talking about intercompany transaction. So transfer pricing also helps companies to structure their intercompany transactions in a way that minimizes tax liabilities. And on the tax administration side, it provides the FIRS with the means to scrutinize and adjust intercompany prices to prevent tax avoidance. So let's take a closer look at how transfer pricing is used as a legitimate tax planning tool, provided it complies with legal requirements. So companies can engage in various intercompany transactions, such as the sale of goods, provision of services, or licensing of intellectual property between related parties. However, these transactions must be transparent and comply with transfer pricing regulations. Let me say, for example, a Nigerian subsidiary may sell raw materials to related entity abroad or in UK, or one company within a multinational group may license patents to another. But to avoid tax manipulation, Nigerian Transfer Pricing Regulation 2018 were enacted, requiring companies to comply with the arm's length principle. Principle. Now, we've looked at the key components, we've looked at the profit allocation, we've looked at the intercompany transaction, and we've also talked about the use of intangibles in our previous modules. However, intangibles are also, strategically managing and pricing intangible to benefit from favorable tax regime is also another key aspect of tax planning. However, you must ensure that the prices of this patent or trademark to other related entities are at arm's length principle or meet the arm's length principle. Now, operational structure. You can also, as a result of tax plan, you can also design your operational structure, either by centralizing or decentralizing to maximize tax benefit while also maintaining business efficiency. Now, let me just say something about the arm's length principle here again. The arm's length principle is a globally recognized standard in transfer pricing. It requires that transactions between related entities be priced as if they were between independent parties in similar circumstances. Now, this principle ensures that companies do not artificially shift profits to low tax jurisdiction in an effort to evade taxes. In Nigeria, for example, the FIRS enforces this principle through the Income Tax Transfer Pricing Regulation 2018, which aligned with the OECD guideline. So if the FIRS determines that the prices set between related parties are not at arm's length, it can adjust the company's account to reflect the correct taxable amount. So we have to be very, very careful when doing tax planning. So with respect to centralized functions such as research and development, procurement, and management services in jurisdictions with favorable tax regime. Those are some of the strategies. Use of holding companies, establishing holding companies in low tax jurisdictions to hold and manage valuable intangibles. All these must still be done at arm's length when you are doing such tax planning. Cost sharing agreements. We spoke about this in one of our modules. Implementing the cost sharing agreements to allocate development costs and profits from intangibles among related entities. So now, let's say, for instance, if a Nigerian subsidiary sells a product to a related party or a related entity in a low tax jurisdiction at a price significantly below the market rate, the FIRS can adjust the price to reflect the actual market value, thereby increasing the taxable profit. That is why it is important that you must always even if you are structuring your transaction or if you are doing tax planning, you must always do it in such a way that it aligns with the arm's length principle. So let us also just explore the Nigerian transfer pricing regulation for a proper understanding and how they ensure compliance with the arm's length principle in related party transactions. You see, this 2018 transfer pricing regulations cover several key areas, including the definition of connected person, methods for determining arm's length principles, prices, or method for determining arm's length prices and penalties for non-compliance. You see, when you are doing tax planning, you need to understand the relevant regulations, the relevant laws, of what you want to plan about. Because if you don't understand the relevant tax law, what are you planning exactly? What are you planning? So first, you need to understand the definition of connected person, methods for determining arm's length principle, and penalties for not compliance. This should be at the back of your mind when planning. Now, let's look at the regulation. The regulation defines the connected person as entities that have control or influence over another entity's financial, commercial, or operational decisions. So this broad definition ensures that all related party transactions are properly identified and monitored. So when considering strategic tax planning, you need to have this at the back of your mind. The regulation also specifies 5 methods for determining arm's length principle. You need to understand this method to be able to plan effectively and efficiently, like the comparable uncontrolled price method, the resale price method, cost plus method, transactional net margin method, transactional profit split method. These are the things that we've looked at in our previous modules. So you need to understand this thing very well. Company must also apply this method to ensure that their transaction reflect market condition, and the FRS uses this method to also review and adjust your transfer pricing arrangement where necessary. So it is important to look at that. So now looking at the overview of the transfer pricing planning, transfer pricing implication in tax planning. Transfer pricing directly impacts tax planning by determining the allocation and expenses across jurisdiction. Proper transfer pricing ensures that tax planning strategies comply with the arm's length principle and local regulation. Very, very important, just like I explained. Compliance. One of the implications that compliance, ensuring that transfer pricing strategies align with the local and international regulations to avoid penalties and dispute, like I said. Structuring your intercompany transactions to optimize tax liabilities while maintaining compliance. Risk management also, you need to also plan accordingly to mitigate risk associated with aggressive tax planning by maintaining robust documentation and transparency. Double taxation. Avoiding double taxation through consistent application of transfer pricing policies and leveraging double taxation agreements. So the key consideration are the regulatory changes, staying updated on regulatory changes and the BEPS initiative to adjust tax planning strategies accordingly. Economic substance, ensuring that intercompany transactions reflect the economic substance, economic substance of the activities performed. Then documentation, you need to maintain a comprehensive documentation to support your transfer pricing arrangement and tax planning strategy. Now, before we go to the case study, let me just say something about compliance and reporting obligations as well. Now, let's look at compliance and reporting obligation under the transfer pricing regulation, because we have to be looking at the laws, interpreting it to ensure that we are planning accordingly, and the things to look at when planning. So now, for example, let's look at the compliance and reporting obligation. So companies that engage in related party transaction must submit transfer pricing documentation to the FRS, just like I said, demonstrating that their transactions are conducted at arm's length. However, even in tax planning, there are some things that you need to know. That's why I said understanding the transfer pricing regulation is very, very important. Let me give an example. For companies with related party transaction exceeding 300 million, annual transfer pricing documentation is mandatory. What this is saying is that if your intercompany or related party transaction is below 300 million naira, annual transfer pricing documentation is not mandatory. However, for companies with related party transactions exceeding 300 million. You need to take note of that. Annual transfer pricing documentation is mandatory, and failure to comply with this requirement can result in significant penalties. Now, however, even for the fact that you do not meet the threshold of 300 million, FIRS could still write to request for documentation. They still have the power to request for documentation, but if they do not, it is not mandatory for you to have it's not mandatory for you to have transfer pricing documentation. So now let's look at the DEMPE functions for intangibles, because we are looking at transfer pricing holistically. So when it comes to intangibles, companies must adhere to the DEMPE functions. I call it DEMPE functions. So now the full meaning of DEMPE: one, the D stands for development, enhancement, maintenance, protection, and exploitation. So this is focusing on intangibles now. So these functions must be reflected in the pricing of transactions involving intellectual property. Now let me say that again. When it comes to intangibles, companies must adhere to the DEMPE functions, and the DEMPE function is development, enhancement, maintenance, protection, and exploitation. So these functions must be reflected in the pricing of transactions involving intellectual property, which is intangibles. So if a Nigerian company performs these DEMPE functions, it is required to report and pay tax on the profit generated from the intangible asset. So now let's go to this case study. Now, Global Tech Limited, a multinational technology company, implements a strategic tax planning initiative to centralize its R&D functions in Ireland, a jurisdiction with favorable tax incentives for innovation. There is no problem. There is nothing bad in centralizing such function in a favorable jurisdiction. Now, establishing a research and development hub, Global Tech Limited establishes a centralized research and development hub in Ireland, transferring its research and development activities from various subsidiaries. Now, cost-sharing agreement: the company implements a cost-sharing agreement to allocate these research and development expenses and profit from resulting intangibles among its subsidiaries. Then transfer pricing documentation: Global Tech also prepares detailed transfer pricing documentation to justify the allocation of cost and profit, ensuring compliance with Irish and international transfer pricing. So it is very, very important. Well, the outcome, of course, when you plan efficiently, taking into consideration both international transfer pricing guidelines and the local tax regulation. Let's say, for example, Nigeria, where you've exceeded the 300 million threshold and you comply with other transfer pricing compliance requirements, you've used the most selected appropriate method, you've taken into consideration the arm's length principle, you've looked at the local laws, you've looked at every implementation, the administration, and what needs to be done accordingly. Of course, the outcome will definitely become tax efficiency. You have a robust compliance mechanism, or robust documentation that also adhere to transfer pricing principles, ensure compliance and mitigate your audit risks. Then innovation for growth: decentralized structure enhances collaboration and innovation within the company. Yes, once you centralize the structure, it enhances collaboration and innovation within the company. So this is another case study: the use of a holding company for intangibles. Let's use Pharmaco, for example, a global pharmaceutical company that established a holding company in Switzerland to manage and license its valuable patents and trademarks. Now, implementation: establishing the holding company. Pharmaco, in this particular case study, creates a Swiss holding company to hold and manage its intellectual property. The licensing agreement arrangement: the holding company licensed the intellectual property to Pharmaco Inc. manufacturing and distribution subsidiary, charging arm's length royalties. You can see that everything is always at arm's length. Transfer pricing analysis. The company also conduct transfer pricing analysis to determine appropriate royalty rates and prepares comprehensive documentation to support the prices. Now, the outcome, of course, will always be tax efficiency. You'll be able to mitigate transfer pricing risk, and then profit allocation. The strategy ensures that profits from intellectual property are appropriately allocated to the jurisdiction managing the IP or the intellectual property. Another case study is when you are leveraging the double tax agreement to avoid double taxation. So a retail group, for example, let's say retail group limited, a multinational retail company that faces potential double taxation on intercompany transactions between its subsidiary, let's say in US and Germany. Now, the transfer pricing policy implements a consistent transfer pricing policy to allocate profit and expenses between the German and US subsidiary, following the arm's length principle. Now, double taxation agreement, where there is a double taxation agreement between both jurisdictions, the company also needs to leverage the German-US double tax agreement to address potential double taxation issues. Now, where there is a dispute, and mutual agreement procedure, retail group limited can also initiate the mutual agreement procedure to resolve a dispute with tax authorities regarding the allocation of profit. So in this particular case, of course, the company can avoid double taxation and can also adhere to regulatory compliance, adhere to the double taxation agreement, and also prepare consistent transfer pricing policies to ensure compliance with both German and US regulations. So risk mitigation tool is also there. The proactive approach minimizes the risk of future disputes and penalties. Before I move to before we round up in this particular module, let us look at the challenges and opportunities of transfer pricing in Nigeria. Just to also understand, because by knowing the opportunities and challenges, you can also, do your tax planning appropriately. So while transfer pricing regulations provide a framework for fair taxation, they also present challenges and opportunities. On the challenges side, compliance with the regulations can be costly and time consuming, especially for smaller companies. And in addition, adjustment made by the FRS may lead to disputes, resulting in further administrative burden and cost. So you have to also take this into consideration before doing planning. However, there are also opportunities. Companies that comply with transfer pricing regulation can engage in permissive tax plan, just like we have mentioned, legally minimizing their tax liability. Additionally, double taxation agreement can be used to prevent companies from being taxed twice on the same income. Let's look at the penalties. The penalties for non-compliance in Nigeria is also very, very high. So because failure to comply or failure to file a transfer pricing declaration results in a penalty of 10 million naira plus 10,000 for each day of default. Similarly, incorrect disclosure of related party transactions also results in a fine of 10 million or 1% of the value of the incorrectly disclosed transactions. Non-compliance with transfer pricing documentation requirement can also attract a penalty of 10 million or 1 million of the value of the related party transactions. And these penalties highlight the importance of complying with transfer pricing regulations to avoid both financial and reputational risk. So now, in conclusion, you see that strategic tax planning with transfer pricing is essential for optimizing tax efficiency while ensuring compliance with local and international regulations. And by centralizing functions, leveraging holding companies, and utilizing the double tax agreement, companies can achieve significant tax benefits. So by also adhering to the arm's length principle, companies can effectively manage their tax liabilities while remaining compliant with Nigeria's tax law. The Transfer Pricing Regulation 2018 provide a clear and transparent framework for multinational enterprises to conduct related party transactions while ensuring that the FIRS collects the appropriate tax revenue. And through robust documentation, compliance with the regulations, strategic use of double taxation agreement, companies can mitigate their risk while achieving significant tax savings. Ultimately, transfer pricing helps to balance the interests of both taxpayers and tax authorities, ensuring a fair distribution of tax revenue across jurisdiction. Thank you very much for your attention and time.